If we had said what we were actually doing, people would have gone nuts. If I lend you $100,000 at near zero interest rates, I'm just giving you the ability to make money.
If this sounds like the beginnings of an unlevel playing field, it's because it is.
Let's talk about the speed with which we are watching this market deteriorate. We're down over 16%. Dow has fallen about 18%, 21%,
43%.
What in the world is happening on Wall Street?
I was there in 2008. I remember this distinctly when the Treasury Secretary came out and said, if we don't give the largest banks in this country $1 trillion in the next 48 hours, there will be no groceries on the shelf by Wednesday.
Welcome back to Stacked Against Us. Last time, we followed the stories of tenants living in homes managed entirely through apps.
Where do we begin? The communication with this company is non-existent.
We uncovered how a tech-driven model that promised 24/7 support instead consistently delivered neglect.
The water heater was completely gone. There was no stove in the house. The refrigerator wasn't working.
And how the very structure of these companies seemed to guarantee that outcome.
I don't think that this is an entity that's set out to become a slumlord, but I got to tell you, they are absolutely on that path. And once you're on that path, short of a major capital infusion, I don't know what you do.
But all of that left us with a bigger question. How did our system enable this in the first place? Answering that requires a bit of time travel. So I called up Chuck Marohn, the founder of Strong Towns, to tell me a little bit about 2008.
And I remember thinking, that's a possibility? Like, that's an outcome? Like, we have this system, and like one of the potential outcomes is that the whole thing crashes and we all starve? Like, that seems like a very fragile system. Let's pretend that that is like a 1% possible outcome, that like you roll 100-sided dice and 1 out of 100 times we all starve because there's no food.
If you read 50 books about the 2008 financial crisis or subprime mortgage crisis or housing crisis, however you know it, you'll come away with 50 different theories as to what exactly happened and 50 answers to the question, what should we have done? More regulation, less regulation, austerity, stimulus. The policy ideas are all over the map. But what everyone can agree on is what we ultimately did. We decided that our biggest financial institutions were too big to fail.
The Citigroup is too big to fail.
Too big to be allowed to fail. Too big to fail.
And so we redesigned the economy to make sure they wouldn't.
What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
At first, that meant giving government aid to our banks, known to many as bailouts. The rationale was that these institutions were so interconnected with the broader economy that their failure would trigger systemic collapse.
No groceries on the shelf by Wednesday.
But bailouts didn't address the underlying problem.
We put trillions and trillions of dollars behind the financial system, and it wasn't enough.
Simply keeping the banks solvent wouldn't address the fact that nearly 5 million homes had been lost to foreclosure between 2007 and 2011. Prices were still falling, making even healthy banks reluctant to lend. Foreclosed homes sat empty, dragging down surrounding property values. Cities were hemorrhaging tax revenue, and neighborhoods were hollowing out. Some were turning into ghost towns. That's the backdrop in 2012 when Ben Bernanke, then chair of the Federal Reserve, released a white paper. The premise was this: regular homebuyers couldn't possibly absorb the millions of distressed homes flooding the market, but maybe someone could.
I looked at it and said, we have a lot of defaulted houses. There's people who need to rent those houses. And so repurposing those houses for rentals could be very good for both the economy and for investors.
That's the voice of Don Mullen. Don was a partner with Goldman Sachs right at the heart of the subprime mortgage crisis. And in the lead up to 2008, he sensed trouble.
Something bad was going to happen and chaos would ensue.
He was, of course, right.
while Goldman was selling mortgage-backed securities to clients, and many financial firms were chasing after these risky assets. Mullen's team bet that they would fail. And fail they did.
Don's idea of repurposing these distressed homes for rentals is exactly what Bernanke enshrined in that white paper. He outlined how a combination of policy and financing could make it attractive for investors, people like Don, to scoop up foreclosed homes, renovate them, and rent them out. If ordinary people couldn't buy, they could at least rent. And if investors had a clear incentive to step in, maybe we could stop the bleeding. In other words, line needed to go back up. And this, Bernanke suggested, was the fastest way to do it with the tools already at hand.
That was the marketing brochure, right? Because if we had said what we were actually doing, people would have gone ape. People would have gone nuts. Because what we did is we gave privileged capital to banks.
How do you make something attractive to investors? Well, one way is to lower the risk. And how do you lower the risk? Well, you can make borrowing cheap, real cheap. Enter the zero interest rate policy, or ZIRP. I'm going to oversimplify this, but in essence, low interest rates makes borrowing cheaper. Cheaper borrowing encourages more investment, like in housing. This, in turn, should increase demand and drive prices back up, or at the very least, keep them from falling. Think of it like slipping a board under a sagging mattress.
Asha, if I lend you $100,000 at near zero interest rates, basically anything you do with it, including just put it in the bank at slightly above zero interest rates, is going to make you money. Like, I'm just giving you the ability to make money, right?
ZIRP made liabilities look like opportunities. In normal times, few investors would touch foreclosed homes. And those with subprime mortgages, forget it. They were literally known as toxic assets. But with government backstops in place, you essentially had nothing to lose. You could borrow at 1 to 2% and buy rental properties generating 6 to 8% returns.
I'm just giving you the ability to make money.
Besides ZIRP, you had quantitative easing.
On September the 13th, the Federal Reserve, the US Central Bank, announced a new program of quantitative easing, the creation of money to try and boost the economy.
That's from The Economist, by the way.
Quantitative easing involves the creation of new money, not the literal printing of money as used to occur, but the creation of money with a click of a computer mouse. When an investor sells government bonds or another asset to the central bank credits the bank account of that investor with new money. The aim is to encourage investors to leave safe assets like government bonds and invest in riskier assets like shares. And it's also to stimulate lending in the economy by keeping interest rates low.
And as a result of all this new money,
like Pavlov's dogs, the stock market salivated.
Hedge funds and private equity firms began scooping up foreclosed homes in bulk. Even Fannie Mae and Freddie Mac, the government-sponsored enterprises that were originally created to help families buy homes, started selling off bundles of these foreclosed properties directly to Wall Street. If this sounds like the beginnings of an unlevel playing field, it's because it is. But I don't want us to get out our pitchforks just yet, because there's a lot more to it. For now, the big question is, did this actually work? And in a narrow sense, yes. Empty homes were reoccupied. The lights came back on, the lawns got mowed, and neighborhoods didn't turn into total ghost towns. Of course, this time, those homes were filled with renters and not owners, but we'll get into that later. Did it save the economy from tanking further? Well, here's the thing. In many ways, the housing market is the American economy. Homes are the greatest source of wealth for most American families. Property taxes are the dominant source of revenue for most local governments. Home construction and related industries employ millions of workers. And mortgages, their origination, their bundling and trading, they form the heart of most banking operations. Therefore, a threat to the housing market is a threat to the entire economy. So, yes, the policy worked insofar as it prevented further collapse. It slipped that board under the sagging mattress, so to speak. But here's what we got in return.
Since the housing market crashed, the way many people rent single-family homes has changed. Local landlords are increasingly being replaced by big corporations.
Before 2010, institutional landlords didn't exist in the single-family rental market. Now there are 25 to 30 of them. That's what the New York Times reported in 2021. The pace was astonishing. A 2024 report from the Government Accountability Office shared that in 2011, no single investor owned more than 1,000 homes. Yet just 4 years later, investors had snapped up between 170,000 and 300,000 homes. By 2022, 500,000 homes were held by just 32 firms. And by the end of this decade, analysts expect that number could balloon to as many as 7 million homes. When you see how quickly this sector scaled, you get a sense that all those policies I mentioned earlier triggered a gold rush.
It's all part of an enormous bet on what some consider the hottest new asset class on the street, America's single-family homes.
The single-family home. 1 or 2 stories, maybe a front porch, a backyard, a garage, probably detached, probably in a cul-de-sac. The type of home that for the longest time was owned by the people who lived in it. If you rented one, your landlord was local. If not, he lived the next town or 2 over. He was maybe managing 1 or 2 other properties, but definitely not 100. He was trying to supplement his income, not build an empire. Now, that's not to say that these mom and pop landlords, as they're known, were always good landlords. That's an entirely separate conversation. The point is the relationship was closer, more personal. And critically, this was the one corner of real estate that for the longest time was virtually untouched by Wall Street. Apartment complexes and commercial properties had already been converted into tradable assets. But single-family homes were, to quote the Wall Street Journal, the final frontier in real estate for the institutional investor. So, who were some of these institutional investors?
The biggest players in this new game include New York private equity giant Blackstone through its subsidiary Invitation Homes, Colony American Homes, a unit of $20 billion investment fund Colony Capital, and California-based American Homes for Rent.
Real estate analyst Jade Rahmani remembers when these players arrived on the scene. Back in 2011 and 2012, he was attending single-family rental conferences in Phoenix and Miami, and at first, those rooms were filled with solo operators, maybe a couple of doctors or dentists pooling their money, buying homes one by one with bank loans. But over time, he noticed the crowd shifting. More and more private equity was in the room. Blackstone would begin sending entire teams to carry out bulk purchases.
The major institutional players have put in about $20 billion to acquire north of 150,000 homes.
That's Rahmani. And let me repeat what he said. In just over a year, a handful of investors had acquired 150,000 single-family homes. Almost 40,000 of those homes were scooped up by Blackstone alone, and 900 of them were sold at a single auction in Georgia on a late summer Tuesday in 2012. That Tuesday was dubbed Super Tuesday by some of the investment firms that showed up. All of the homes up for grabs were under foreclosure. Colony Capital, one of the big guys, reportedly spent $3 million in cashier's checks just on that one Georgia auction. It also sent roughly 50 employees to no fewer than 7 auctions across the state that same day, ultimately spending $9 million by sundown. By October 2012, the National Association of Realtors estimated that 1 in 5 home sales nationwide was going to an investor like Colony or Blackstone.
So today, we own about 30,000 single-family rental homes across the U.S., largely in the Sun Belt, and we've got probably about 75,000 people living in our homes.
That's from an episode of 60 Minutes featuring Gary Berman, CEO of Tricon Residential. Tricon's growth was explosive.
Our largest portfolio would be in Atlanta, in Charlotte, in Phoenix, in Tampa.
In some neighborhoods, it really feels like every other home is owned by a Blackstone. There are entire counties in Florida, Georgia, and Texas where up to 30% of the homes trace back to a corporate landlord.
We hear from community organizers that are door knocking in certain neighborhoods and are just surprised by how many of the homes on a particular block will be owned by a corporate landlord.
But let's rewind real quick.
It's all part of an enormous bet on what some consider the hottest new asset class on the street, America's single-family homes.
Asset class. The problem isn't that Wall Street could now buy single-family suburban homes and rent them out. The problem is what that revealed about housing itself. Remember that sagging mattress analogy? Our crisis response didn't just stop the sagging. It changed the very nature of what we were sleeping on. To begin unpacking this new thing we're sleeping on, it's worth asking how these firms could afford to scale. No, really. These firms weren't buying homes the way you or I would, scraping together a down payment, taking out a mortgage, waiting on a bank appraisal. They came in as cash buyers. But as well capitalized as they were and as attractive as our policies may have been, it's not like they had billions of dollars in cash just lying around. No, they had to fashion specific financial instruments for the occasion.
You've heard of mortgage-backed securities and their role in the housing market collapse. Now there's something called rental-backed securities. They're bonds backed by single-family rental homes. This new investment vehicle may be hitting the market next week.
That's from October 25th, 2013, when Blackstone unveiled the very first single-family rental-backed security. Within months, American Homes for Rent cut a deal with Goldman Sachs for their own version. By March 2014, Colony Capital had a $513 million bond on the market, backed by 3,000 rental homes. How do these securities work? The traditional approach is this. Say you want to buy a food truck. You borrow $50,000 from the bank, promising to pay it back with interest from your food sales. If the food truck fails, you still owe the bank $50,000. In the securitization approach, you also borrow $50,000 to buy the food truck, but you immediately sell food truck securities to investors that promise them the revenue from your food truck for the next 10 years, let's say. You use that money to pay back your original loan. Now, if the food truck fails, you've transferred most of the risk. The investors can lose their money, but you already got paid up front. There's obviously a lot more nuance to it, but I feel like that's a solid 101. The thing is, it's not like securities themselves were new.
The creation of securities was used first in the 1930s to stimulate homeownership.
That's Maya Aboud. Her MIT master's thesis, Securitizing Suburbia, is essential reading if you want to understand the financialization of single-family rental homes. And she's right. By the time Blackstone announced their new security, we had been hearing about securities for years, specifically mortgage-backed securities. They were like the boogeyman of the financial crisis.
And Blackstone was like, hey, we can do this with single-family rentals. And there was all kind of negotiation back and forth, and then they proved they could do it. And what it meant is now they can take out debt financing, they can have all these debt investors, and they can get tons of money now for future payments of rent later. And that allowed them to buy more homes and do more securitizations, and then inevitably allowed them to go public and become a real estate investment trust.
So, to sum it up, securitization gave these firms liquidity. It gave them cash to keep scaling. And I mean literal cash. Foreclosure auctions required cash. And sellers outside of auctions preferred it too, because cash meant speed, certainty, no waiting on loan approvals or risking a bad appraisal. It also meant discounts. In Atlanta, institutional buyers were paying 6 to 12% less on average than individual buyers for the same kinds of houses. Maya mentioned another tool, the Real Estate Investment Trust, or REIT. If you're a wealthy person, instead of buying a house yourself, you can buy shares in the REIT, which owns thousands of homes. The REIT collects rent and then by law is required to distribute 90% of its taxable earnings to shareholders. That makes it a really attractive investment. So it's no surprise that once Blackstone, Colony, and all the other giants built REITs, the world's money showed up. I'm talking Qatar's Sovereign Wealth Fund, Columbia University's endowment, some teacher retirement fund in Texas, the University of California system, even Korea's national pension. Everyone wanted a piece of the returns these REITs were promising. If ZIRP and quantitative easing opened the door to institutional investors, securitization and REITs got them through that door. But the financialization of housing takes us headfirst into what Chuck Marohn calls the housing trap.
The housing trap is actually kind of simple. Housing for everybody is shelter. It serves the base of Maslow's hierarchy of needs. We all need food. We all need shelter. When we have food and shelter, we can start to talk about things like security and ultimately getting to prosperity. But like shelter is the base. Every human needs this. So a home serves as that. In our economy, a home also serves as a financial product.
Chuck co-wrote a whole book about this, but he's not the only one who's made this point. Back in 2017, the United Nations Special Rapporteur on Housing, Leilani Farha, essentially said the same thing. Here she is speaking on the TED stage.
Housing is now viewed as an asset, a commodity, a way to grow wealth. It's not viewed as a home, a place of warmth, security, where we grow our families and share memories and stories.
Let me spell this out. Housing is trying to do two completely different jobs at once. Job number one, shelter. This is a basic human need. You need a roof over your head, a place to sleep, to raise kids, to store your stuff. For this job to work well, housing should be affordable and abundant and stable. Job number two, investment vehicle. This is where housing generates wealth. Your home appreciates in value. You build equity. You can borrow against it, sell it for more than you paid. For this job to work well, housing prices need to keep going up. If housing is a good investment, it gets more expensive over time. If housing gets more expensive over time, it becomes harder to afford as shelter. But if housing becomes affordable as shelter, it becomes a terrible investment. I think you get the point, but that's the trap. The trickier truth is that housing isn't just an investment vehicle for homeowners or some guy on Wall Street. We're all tied up in this. Securitization and REITs braided housing into our 401ks, our pensions, our life insurance policies. It makes us dependent on the rental payments of some family in suburban Georgia. We actually benefit when that Georgia family's rent goes up or when they don't get their security deposit back. Their loss pays someone else's dividend, a teacher's pension in Arizona, an office worker's 401k in Pennsylvania. Here's how Maya put it.
And what all of it means in practice to someone paying their rent is that there are now all of these people whose future earnings that are very important to them, their retirement funds, their pension fund, all of the different investors depend on you paying your rent. This entire castle, this entire house of cards, the premise is you paying your rent. And if you don't pay your rent, then the house of cards will crumble. And so suddenly that rent is really important in a way that it wasn't under mom and pop ownership. In mom and pop ownership, like the individual needed the rent payments in order to pay a mortgage. But if that one mortgage failed, your entire economy doesn't fail. Or an entire segment of the stock market, or all of these investors don't suddenly get up in arms. It's like one person that's impacted. The movement of housing into financialization is that it becomes your rent payments, your mortgage payments are part of this global financial system that depends on it. And it means it becomes much more regulated, constantly increasing, and housing becomes less and less affordable because that's the only way that the business model can work.
When your incentive above all else is to deliver returns to shareholders, you're going to look for ways to cut corners and save costs, like in the maintenance of the homes.
In Dallas, Texas, disaster in the living room.
These are just a few of the issues Rebecca has had to deal with over the last few years while renting her home in Middleburg from Invitation Homes.
The latest is a $1,300 landscaping bill for grass that never grew.
I've paid them $74,000 over the last 3 years, and this is what we have in return.
Tens of thousands of families live in those properties paying rent. But the company is now dogged by complaints of shoddy maintenance and an aggressive eviction policy.
What about taking stock in his tenants?
Do they fix anything? What do you mean by fix?
You're going to obsessively squeeze ancillary revenue out of tenants, from keeping their security deposits to charging termination fees. In fact, in a 2016 earnings call, the chief executive of one of the big firms described failing to recoup these random fees as revenue leakage. That particular corporate landlord made over $20 million in just fees and tenant clawbacks that same year. And finally, you're going to exert an almost mechanical pressure to raise rents year after year. Because without ever escalating rental income, the returns you've promised investors can't be met. I really like the way Maya articulated this when she was interviewed by the New York Times.
Because of the way our financial markets are structured, stockholders expect ever-increasing returns. All of this creates so much pressure on the companies that even if they wanted to do the right thing, which there's no evidence that they do, all of the entanglements lead to an incentive of not investing in maintenance, transferring all the costs onto tenants, constantly raising rents. Even little tiny nickel and diming, if it's done across your entire portfolio, like little fees here and there, you can model those, you can predict those, and then that can be a huge revenue source.
But now, after all that, I feel like we're back to where we were in episode 1 when Chuck said this.
You see that by kind of force of we can't lose money or we can't abandon this model or we have to keep going down this route, you see it becoming increasingly predatory. And I think that's a standard way that these models evolve because you're more sensitive to the bank that you owe money to than the tenants that you have 1,000 miles away.
The way this is all set up, how could this play out any differently?
And these companies will make an argument that they're good for tenants. And I think in a sort of Econ 101 way, you could maybe imagine that they should be. They should be able to achieve economies of scale when they buy toilets and washing machines and pass on those savings to the renters.
That's John Johnson, a research fellow at the Marquette Law School Lubar Center. A lot of his work focuses on quantitative trends in housing and demographics in Wisconsin.
In reality, we see that they push rents up really aggressively. And I spent a lot of time measuring like eviction filing and code violation rates in Milwaukee, and they're high on those metrics as well. When you do a bunch of statistical controls, they're higher than other landlords who operate in the same neighborhoods. All else being equal, they file evictions against their tenants more frequently. And the people who file evictions the least frequently against their tenants are landlords who live close to the properties that they rent, which is a neat thing you can do in parcel data. You can measure the difference between the home address of a landlord and their rental properties. So neighborhood landlords seem to provide the best quality experience to tenants. And I think that makes sense. I think if you think about like who's the best person to rent from, it's probably somebody you know.
I originally connected with John to talk about SFR3. Remember them from episode 1? He has been tracking their activity since they first popped up on his radar. And now that we know about securitization and REITs and the policies that laid the foundation for what we're seeing, it's about time we weave them back into this story. Because what does it tell us that new players are still entering a market Wall Street carved out more than 10 years ago? And how do we begin to challenge this paradigm? I feel a little bad leaving you with this cliffhanger, and I know the story so far has felt heavy. Systems so massive they seem untouchable, like a monster that only another bigger monster could defeat. But maybe that fight doesn't need to start at the top with a bigger monster. Maybe it starts from the bottom up. And I promise you, we'll get there. See you next time.